Hello, everybody. We are going to give folks just a few minutes to show up before we get started. But so happy to hear you, or so happy to, glad that you're here. Thank you for joining us. Appreciate you being here. Hello. For those of you just joining us, we're going to give folks just a few minutes to show before we get started. Thank you so much for being here. Okay, we are a couple minutes after the hour, so I am going to go ahead and get us started today. Hi, everyone. My name's Kristina Hughes, and I am Senior Manager of Product Refinement at American Forest Foundation. Thank you so much for joining us for this webinar to overview the Permanence Trust and some early findings from a feasibility study being led in partnership with AFF, KETA, and Climate Resilient Solutions. As carbon markets have scaled, they've delivered real momentum for climate mitigation and carbon removal. But alongside that growth, one challenge has become increasingly clear: permanence. When we issue a carbon credit today, how confident are we that the climate benefit that it represents will still be out of the atmosphere decades from now? Reversal risk isn't new, whether from wildfire, ecosystem change, economic shocks, or policy shifts. What's new is the scale of those risks under a changing climate and the limits of approaches that rely primarily on prediction, such as buffers or long-term assumptions. So the Permanence Trust is a response to that challenge. Today, we'll share early findings from our feasibility study, how permanence risk can be quantified, how it can be priced using empirical data, and how a trust structure could create a scalable, equitable path for carbon credits to achieve meaningful durability across project types and geographies. Today's presentation on the Permanence Trust and the feasibility study will be led by AFF's lead scientist, Lynn. Unfortunately, Racheal Notto is unable to join us today, so I will be covering her portion. And we are also joined by Founder Director of Climate Resilient Solutions, Dr. Bali. Please use the Q&A function in Zoom to drop your questions, and we will answer as many of them as we can at the end of this presentation. We will also collect these questions and bring them back to the full analysis team for consideration and response. So Lynn, if I could turn it over to you to get us started.
Yeah, thanks, Christina. So I want to start briefly with just sharing the design challenge that we saw that led us to think about something like a permanence trust. And that is, American Forest Foundation, as we were getting started building nature based projects with small family landowners, we realized really early on that landowners, ourselves as a project developer, and even standards and registries are equipped and set up and have mechanisms to manage reversal risk for these projects really well during what you might see on the left side of this graph. So during the time that the project is active and maybe a little bit after, we have a crediting period with the black line here of the project performance and the white line of the baseline. We're getting credit for the delta between those two. And then at the end of the crediting period, we have mechanisms like buffer pools that set aside credits to manage reversal risk over a specified time period. Typically, buffer pools in use today use a time period of like 100 to 200 years. However, what we also hear in the market today is a desire for longer term durability thresholds. And even those 100 to 200 years that buffer pools cover, like Christina said, right now there's a strong reliance on prediction of reversal risk. And there's really no mechanism or entity that is set up to monitor for actually realized reversals so that we can carry out the right side of this graph where we can actually identify, hey, here was a dip in carbon storage, that's a reversal, and there is a liable party who exists to do something about it. So there was kind of this design challenge where on the supply side of landowners, projects, and standards and registries, we're saying, here's what we can do, here's what we can commit to, and what we're resourced to do for monitoring and liability. And then on the demand side, we hear, hey, we actually need a longer durability threshold for the way that we're using these carbon credits, and we need really clear liability for the monitoring and who's going to be around to compensate for them. So that's really the gap that we saw in the design challenge that we saw that led us to think, okay, what's a mechanism that could work to do this? That's where we came up with the Permanence Trust. We think of this as sort of a new piece of market infrastructure that we are proposing. You can also think of it as a form of contracted durability where we are guaranteeing the achievement of a specified durability threshold through a contractual mechanism that says there will be a resourced party to manage the reversal risk over whatever that specified durability threshold is. This graphic says 1,000 years, doesn't necessarily have to be that. That could be a policy specific durability threshold, but whatever that is, there needs to be a clear party who's liable and equipped to carry out that monitoring for realized reversals, truing that up if it's different than what we expected when we predicted reversals, preventing reversals, and ultimately compensating for them where we do identify them. So really briefly, a quick kind of how we think this could work is during the left side of this graph, when a project is active, it's issuing credits, there would be a fee issued per credit based on our expected reversal risk for whatever carbon reservoir that credit is associated with. That fee would be placed into some sort of trust. It could be like an endowment type of institution to be grown and managed to carry out those kind of three main activities of monitoring for actual reversals, preventing reversals on the ground, and then compensating for them, ideally ultimately fully retiring the reversal liability by compensating for a reversal with a credit that has negligible risk of reversal. So this might all sound like a great idea. That's what we've heard through many, many conversations that we've had with market stakeholders over the past couple years. But there's still lots of questions. So can we actually do this? Will stakeholders buy into this idea? Can we actually assess risk well enough to price it in up front? Will this whole thing be financially viable? We share those same questions. And so We started late last year and are currently midway through what we've been calling a feasibility study into the idea of a permanence trust. We have really wonderful partners that I just want to briefly share about. First is Kita, who is a leading carbon and natural capital insurance provider, and they are leading our expert advisory groups, which we have over 50 expert advisors helping us answer and think about some of those questions I just talked about. They're also leading our financial and legal research, our methodology research, and engagement with carbon standards. We also are really lucky to have Climate Resilient Solutions partnering with us, which you'll hear a lot more from Bali later on. This is a really critical piece for making sure that we can actually lay out a quantitative foundation for how we assess risk. That's really critical to making sure that we are able to price it in accurately. And then lastly, ourselves, American Forest Foundation, we are a conservation organization and project developer working primarily with small family landowners. And we're leading the overall project scope. And so before I turn it over to Kristina, who's going to talk a little bit more about the study, I just wanted to say a few words on some objectives that we've defined that will help us know if we're going in the right direction of what will it take for the trust to be successful. So first, we think we need to design something that can truly deliver a legally binding and financially backed guarantee of whatever the specified durability threshold is. So a way to say in a legally binding way, this credit will be guaranteed to achieve this guaranteed durability. Second, like I mentioned, we really need to build something that can carry out these three functions. So something that's set up to do long-term monitoring, actively prevent reversals in a way that probably means work on the ground. So in a forest-based project, for example, maybe that looks like doing active management to reduce wildfire risk. And then lastly is equipped and resourced to fully compensate for those realized reversals that we identify through monitoring. Third, it's really important to us to anchor all of this in atmospheric outcomes. So for us, that means doing things like including the full suite of climate scenarios in our risk monitoring and ultimately seeing the trust as accountable to those atmospheric outcomes. Fourth, we see the trust as a way to move away from existing mechanisms that are very reliant on sort of ex ante reversal prediction to a more dynamic use of empirical data to both ex post identify real reversals and dynamically use empirical data to assess that risk upfront. So importantly, for us, that means we're not going to assume that a credit is going to be reversed just because it comes from a certain project pathway. As we know and have seen throughout history, ecosystems, for example, are one of our most durable carbon sinks on Earth. At the same time, we do need to be prepared for reversals should they occur. So it's kind of balancing that line and using that empirical data to not assume reversals will occur, but be prepared should they occur. Fifth, in order to carry all of this out, we obviously need to act like a prudent financial institution. So that means being conservative, making sure that we will have financial surplus, financial reserves, above any expected losses and outputs, and set this whole thing up to do ongoing independent stress testing of our financial modeling. Lastly, we really see this as something that should be and must be inclusive and equitable for all projects, not just capital-rich geographies and not just some projects, because like I said up front, the design challenge here is to design for two things, scale and permanence at the same time. And so to do that, we intend to make this something that works for all project pathways. Risk might be differentiated within those project pathways because different carbon reservoirs are going to have different reversal risk, but it should be inclusive for all project pathways and even a variety of durability thresholds. So with that, I'll pass it to Kristina to talk a little bit more about what we're seeing so far in the feasibility study.
Perfect. Thanks so much, Lynn. I appreciate it. I'm going to give a quick overview of how Kita designed this study. and the different research pathways within the study that we're engaging in, and give an overview of where we're at in the study now, and then some findings that we have, um, preliminary findings that we have at this stage in the study. So just a quick overview. Kita is a specialized insurance company focused on the carbon market. Their work centers on reducing risks like project underperformance or non-delivery, improving trust and transparency in the carbon markets, and helping scale high-quality carbon removal and ecosystem restoration projects. So they are the lead partner in designing the study and conducting the study. So the study that Kita designed and that we are currently working through was developed in three different stages. We've completed stage one doing a concept feasibility study and establishing a set of definitions that would be used to help operationalize some of the things within the entity that will be the Permanence Trust. We are currently in stage two and stage three. Stage two, which is being led by Alex Morgan with Kita, focuses on analyzing the most appropriate and functional legal governance and financial structures for a permanence trust, analyzing financial forecasting and looking at things like operational risk management. Stage three of the Permanence Trust is being led by Paul Young and focuses on the methodology behind things like assurance, and also in partnership, strong partnership with CRS and the CAR framework, which Dr. Bali will share more about. Things like reversal risk assessment. Other areas in this stage also include like portfolio management and looking at economies of scale. Throughout each of the stages of the study, we are having strong external collaboration and engagement with many different stakeholders. One of these engagement strategies is the advisory groups, which we've spoken a bit about, and I'm sure some folks on the call right now are actually serving on those advisory groups, which we very much appreciate. And so the advisory groups are made up of industry experts that are feeding in information and feedback throughout the study on various analyses that Kita are leading. And so it's been so incredibly beneficial to have so many experts in the rooms offering feedback throughout the study that are impacting the various outcomes and directions that the study has taken. So here's an overview of the timeline for the study. We started back in 2025 around October, and you can see the various areas that we're working through and how here we are in March of 2026. Each of the advisory groups have met each month, and so we are at about the halfway point for this feasibility study. And so a very high level overview of some of the current key findings from the stage that we're at right now. First, current losses and even forward-looking projected loss rates are within range that can be effectively managed. So this means that the Permanence Trust can maintain stability and likely meet obligations with appropriate capitalization, buffers, and risk management practices. Second, analysis indicates that remediation and replacement obligations can be sustainably funded through an endowment-like investment model, where returns are used to cover losses over time. This should reduce reliance on reactive funding and will support long-term financial stability of an entity like a permanence trust. We are also recognizing at this point that digital MRV is going to play a major role in liability management and also long-term monitoring of the carbon stocks. And currently in the analysis, we are using three different ways to estimate losses. We're looking at past data, insurance style models, and remote sensing. And in our analysis, they are all pointing to similar results, which is that consistency gives us greater confidence in our overall findings of at this point in the study. And finally, we are recognizing that working with standards to integrate that liability transfer mechanism is going to be a critical step. And we have started to engage with the standards bodies more directly to ensure that that critical engagement is incorporated as we build the blueprint for what a permanence trust might look like. So at this point, we plan to spend the rest of 2026 building and supporting evidence for the model. But at this point in the study, it looks very likely that a permanence trust will be feasible. Excellent. Okay, so these are current findings from a lot of the work that Kita has been engaged in. I'm going to turn it over to Dr. Bali Lee to overview some of the work that CRS is engaged in. Thanks so much, Bali. I appreciate it. Oh, and actually, you are on mute, so
Perfect. I think I'm unmuted now. Thank you,
yeah,
Kristina,
absolutely.
and welcome all. So today I wanted to walk you all through carbon at risk, a methodology for modeling best to worst case scenarios of carbon storage outcomes across multiple removal pathways from afforestation to geological storage. But before I kind of get into that, I wanted to give a brief history of how we got here. So, Carbon at Risk, or CAR, began in late 2023 as a small working group consisting predominantly of insurers, academics, and some serious carbon market specialists. And it was really formed around the starting question of, is fungibility desirable? And if so, what conditions does it require? I would say by mid 2024, this focus had shifted to kind of what we are developing right now, which is a metric for quantifying non-permanence or storage risk, because we understood that to kind of answer the question of is fungible desirable, is fungible is it necessary for market expansion? We first needed to understand what the variation between these actual projects and pathways were, and quantify that in relation to their permanence risk. So upon realizing that we had to get to work, we quickly produced a white paper and two proof of concept models covering afforestation and geological storage, which we presented at an LSE workshop in April 2025 to an excellent audience spanning standard setters, financial institutions, policy experts, etc. And they were really excited by the work that we were doing. And as a result, we committed to expanding this methodology to cover biochar and enhanced rock weathering. And we actually ended up turning that initial white paper into an academic paper that was submitted in September 2025. It's available online if you want to see it, but it's currently undergoing revisions and we're planning to resubmit very shortly. So that kind of brings us up to today, where we are now working with the American Forest Foundation and Kita on the concept of a permanence trust, with the ultimate goal of creating something somewhat similar, perhaps, to the GHG protocol, essentially an institute that can not only track the removals that are happening today through our sources and removal activities, but also try and predict what future re-emissions may look like. Adjust those predictions based on empirical data as it comes in, and hopefully continue to advance the science around predicting carbon storage risk. And I would just like to say that none of this would be possible without my excellent collaborators and partners, particularly Professor Ben Groom, Professor Frank Benman, and Dr. Tom Bearpark, who have been leading the quantitative modeling portion of this work. So that's a little bit of our history. But where is CAR now? So CAR is really designed to help us all see risk clearly. And if you know anything about risk management, you know that it's rarely the average that causes things to go wrong. So if you think of your average day, I'm sure you have better days, I'm sure you have worse days. They probably all look quite similar. If you were to think about your best or your worst day, it probably looks very different. And we've already seen this play out to some extent within the carbon markets. So, for example, the California wildfire season of 2024, that was a really bad day, several very bad days. And as a result, we saw that buffer pools ended up being depleted far beyond what was initially planned. So CAR is really designed to help us see that tail risk clearly. So rather than looking at averages, we look at distributions. We look at the best and worst case scenarios across multiple pathways. We also look at multiple time horizons. So rather than just saying expected loss of 50% at 200 years, we try and also identify when those losses are most likely to occur. And increasingly, our work is focusing on understanding the correlations between pathways and projects. So, which pathways and projects fail together under shared risk drivers? For example, a 2 degrees Celsius warming scenario. Hopefully, we don't get there. But currently, out of scope is baseline adjustments. We are looking to take credits as they are currently credited, minus the permanence deductions, because we believe that kind of that baseline methodology question is ultimately a policy question and will be solved by greater standardization. But the question of what actually happens to the carbon once stored is an ongoing academic and research question that will exist for, I imagine, years, if not centuries to come. So, sorry, there we go. What does this mean in practice? Well, essentially, you could say that CAR measures and the PT acts. So CAR asks the question, how bad could it get? What is the maximum expected loss in 95% of scenarios? That answer can be used by the PT to size its reserve. How much should it hold to compensate for those potential losses? We, as I mentioned, ask when a loss is most likely, and this can be used to price premiums. If the losses are more likely to occur later, those premiums could probably be lower. They don't need to, they have time to grow. If those losses are going to happen sooner, then you might want to charge a little bit more upfront. And finally, we're really trying to answer this question of which projects fail together. And this is really important when thinking about how you would compose such a reserve or buffer, as you really want to try and maximize for uncorrelated risk. And this is really kind of quite different, I guess, from the ways that registries and registry buffer pools are currently structured, because this could mean that, for instance, that reserve may include credits that are not under the liability transfer mechanism of the Permanence Trust. And if you know anything about finance, what we're really trying to maximize for here is diversification. So Harry Markowitz famously said that diversification is the only free lunch. And I'll be able to demonstrate a little bit of this when I go through the tool in a second. So to sort of summarize these initial findings, I would say that we found that the risk is quantifiable. Of course, it's not perfect. This will need to be iterated on and continue to evolve over time, just like these risks. But we are able to show that it is possible to do initial proof of concepts upon which decisions can be made. We've also been able to show that portfolios of uncorrelated projects can diversify away a significant chunk of this risk, and that we believe that what can't be diversified away can be covered by these risk calibrated reserves, which are sized using our quantitative modeling. And then hopefully those big unknowns, the black swans, should be manageable through a dedicated growing fund set aside explicitly for this purpose. So you can see how our two sort of research streams have essentially and quite, perfectly dovetailed. Was not designed that way, I promise. So going on to the tool, can we click through? So the tool is live now. If you wanted to check it out, it's available on our website. As you can see, there's a little landing page here which talks through kind of the research and some of the decisions that we've made. I'm going to skip through that now because hopefully I'll have given you a little bit of that context. And let's go straight into the pathways. So we'll go on ARR first, afforestation. And you can see that there's the opportunity to look both at global averages and country deep dive. So if we click on global averages, this covers a bunch of different countries. But yeah, nice. If you scroll down, what you can see right off the bat is that there are significant variations in carbon at risk. This is modeling fire risk and also regeneration capacity between countries. So perhaps if you're trying to do carbon removal using forestries over 200 years, you might think that Australia is not the best place to go. Whereas you can see that the risk is considerably lower in Brazil and the United States. What's also interesting about this tool now is if you click on the 90, the confidence level, you can toggle. So if you click on 90%, you can see that, of course, by sort of restricting the amount of scenarios we look at, if we say, okay, what's the maximum expected loss in 90% of scenarios, that maximum expected loss does decrease. But maybe you don't want to decrease your risk tolerance. So another way that you can also have an impact on this outcome is through diversification. So if you click on this, the one project now, what you can see here, let's have both 1 and 10 projects up. Thank you. You can see here that the most significant reduction in the expected loss comes from diversification. So, we don't need to change our level of tolerance for risk to reduce the expected outcomes. We can actually do that quite significantly just by increasing the number of the number of projects that we are managing. And this does differ with correlations between projects, which is something we'll be adding in shortly. But now if we go to the regional section, so we go back, there we go. And then down to the country deep dive. This is just to show that not only is there kind of countrywide variation, but also maybe we go to 10 projects, quite significant variation within countries. So Australia might not be the best place to do a carbon removal project if you're doing forestry. But Tasmania, small little wet island just off the coast of Australia, does seem to have much lower rates of loss. So this is also important to take into account. Now let's jump to a very different type of technology. We're going to have a look at geological storage. So, well-known permanent solution. But as you can see, and you can see that right there on the left, that there is a much lower percentage of carbon at risk. Like we're barely scraping 1% here after 200 years. But if we were to also include another type of geological storage, so this is looking at offshore, let's look at tick on onshore, unregulated as well. What we see here, if we scroll down a little bit, perfect, is that even within projects viewed as permanent, there can be quite significant differences between the risk of reversals. And so that's more than 10 times increase in the risk of reversal, depending upon the regulatory environment that these projects are being undertaken in. And so a lot of this variation is potentially being obscured by the way that these credits are currently managed. And this is something that the Permanence Trust or something similar could take into consideration. So finally, let's jump to the portfolio builder. Okay, so here you can see that we can choose different levels of tons we want to sequester. It's currently set at 30,000. You can make that all the way up to 100,000. But we'll keep it there for now. And then if you go to generate portfolios, you can see that there are, essentially an infinite amount of portfolios that can be made and generated that would hit that mean target or overshoot that mean target of 30,000 tons of carbon sequestered after 200 years. And again, this is the P95 value. So this is the expected carbon storage in 95% of scenarios. This is not the mean. Now, if we were to then do edge only, thank you, Kristina, you can see that there are multiple different portfolios that go along this line, and these differ in terms of their mean storage capacity and also their standard deviation. So yeah, if you're in that right-hand quadrant, you see that and that one, you see that the mean is around 31,000. So after 200 years, you'd expect to have around 31,000 tons of carbon still stored as a mean. But if you take into account the P95, that does go down to just over 30,000 30,000. And the price of that is around 79.48 tons, right? If we go all the way over to the left, we can see that here we have another portfolio mix. And this one also hits that mean and also hits the P95, but the mean storage is actually a little bit lower. and the overall cost of that portfolio is higher. So essentially, because of the implicit risk pricing that is already in the market, we are already seeing some diversion in terms of overall cost of the portfolio and the risk tolerance that someone is willing to take. So how much could this portfolio overshoot or undershoot that initial target? What's important to note, I guess, is that when you look at the right hand side quadrant, although these do have greater standard deviation, they are actually delivering more carbon at day zero and even more carbon 200 years later because of the fact that you are overcompensating as a result of presumed removals. So that's a little overview of the tool. There are more features coming soon, including the ability to change the correlation between projects and pathways. But for now, I think I will leave it at that and jump over to Kristina or Lynn.
Yeah, Lynn, do you want to share out some of the other engagements and other efforts in this area?
Yeah, thanks. So I think we got some questions in the chat about this too. We are actively having meetings over the next few weeks and months with standards bodies. So there's been a few questions about how might this interact with existing mechanisms that standards bodies use, like buffer pools. In short, we're still figuring that out with standards bodies. But our hope is that and what we envision is that we're not suggesting that buffer pools go away or would not be a tool, but we suspect that a permanence trust would be used in a complementary way to buffer pools. So whatever time period is meaningful and realistic for buffer pools to cover, maybe that's on the order of decades or a few decades after a crediting period, those seem reasonable to be covered by a buffer pool. And then after that point, what the trust would do is create a clear point of liability transfer from the buffer pool being liable for reversals to the trust taking on that monitoring, prevention, and compensation, that whole suite of liability for the reversal. So we think that's how it'll probably work. The specifics of that are still getting worked out as we engage with standards bodies. We also, I think we saw it in the chat too, a note about the Paris Agreement crediting mechanism, which we also do plan to engage with. We know they have some upcoming public consultations on reversal assessments and monetary reserves, which we think the Permanence Trust falls into that sort of category of things that could be used to manage reversal risk. So we plan to engage in those public consultations and with those policymakers, as well as we're very aware of ongoing policy in Europe. There's open conversations right now with California. So yes, we're doing lots of policy engagement. There's also some work that standards bodies have been initiating in this field that y'all might be aware of as well. So Vera has a durability pilot that enables right now fund-based mechanisms like a permanence fund to be piloted. Another pathway in that pilot is an insurance pathway. So we're intersecting with those to see how a trust could also be fit into those pilots. CAR as well has a permanence working group that we are engaged with on the permanence trust as a potential option. So yes, lots of policy engagement, as well as, like Kristina mentioned, we have expert advisory groups that are helping us think through all of these really great questions that y'all have been asking and we've been asking ourselves from all across the market. And those folks are on that web page that is linked in the chat. This webinar is one of our attempts to also provide resources and materials to keep you all and all the stakeholders informed. We're also developing some more materials, and like we said, we expect to have written reports later this month or later this year in the coming months. So if there's specific resources or materials that y'all would like to see or that would be helpful, let us know and we can definitely build those out, especially maybe as you're thinking about your own policy and stakeholder engagement, and if the Permanence Trust is something that you have in mind there. And yeah, like I said, we're also participating in those working groups as those opportunities become available.
Excellent. Thanks, Lynn. So now call to action. How can you all either engage or yeah, if you want to help support this project, definitely share with your networks. When after the webinar concludes, we will send out the slide deck from the webinar. We will send out the recording so you can have that for any of the communications that you want to engage in with your own networks. You can also reach out to us directly. You can reach out using our Permanence Trust email down there, permtrust@forestfoundation.org, and reach out with any questions, or if you want to join our email list. We are sending out regular communications to stakeholders as well. So if you want to join the email list, do send us an email and we can get you added. At this point, I know we've been answering some questions live in the chat, but if folks still have questions, there are several in the Q&A that we're gonna talk through here. But if you have other questions, please do drop them in the Q&A function on Zoom, and we'll spend the rest of the time talking through those questions. I'm curious, Lynn, are there any questions that you have already answered that might be good to just talk through live here in front of the full group?
Yeah, maybe one quickly. So we got some questions on how are we thinking about kind of proactive land stewardship? So I interpret that as how are we thinking about keeping the carbon stored in the carbon pool that it was originally credited in? So maybe that's an ecosystem or it could be soil carbon, whatever that looks like. How are we thinking about that compared with compensating for reversals with a credit that would be in a different carbon reservoir? So maybe it's with a novel CDR credit, for example, that has negligible risk of reversal. And in short, I think we expect to do both of those things where we can actively prevent reversals or restore ecosystems where reversals have occurred. The money in the trust can and should be funding that. And where that's not possible, we do want to retain that option to fully retire the risk of reversal with a credit that has negligible risk of reversal. So maybe that is novel CDR, maybe that's something else. But yeah, I suspect we'll ultimately be doing both, and kind of the design of how we apportion the money in the trust to which activities, that's something that we don't quite have specific percentages yet, but something we're working on and should be coming in future iterations of the study.
Perfect, thank you. All right, so I'm gonna scroll through and I'm gonna ask out loud some of these questions, and any questions that we are unable to get to today, as I said, we will collect those and bring them back to the analysis team and incorporate any answers we are able to in our follow-up email to any of these questions as well. So I guess first question here. Will the Permanence Trust and the CAR framework be able to incorporate claimed removals from off-registry removal projects and insetting?
I don't see why not. I'll say the scope of our study so far has been in the context of carbon markets generally, and we've been talking mostly to carbon market standards. So we haven't engaged much, I would say, so far in kind of off-registry bodies who might be issuing credits. Yeah, I'd love to maybe engage further on that with whoever sent in that comment, and we can definitely think about that. But yeah, so far the scope has been to carbon markets, which I don't see a reason why that couldn't also include insetting.
This one, question for Bali. Do you expect to look at methane capture credits?
So this has been an ongoing question, particularly around oil well plugging. Potentially, we could expand to that scope. Ideally, we would be covering anything that has a risk of reversal and is being used to cover emissions today. So it's in our eye line and our sights, but not for this phase of work, at least.
Perfect. Okay. So question, has the EU and CRCF certification framework shown interest in this as it relates to biochar or geological storage, to BECS and to DAX? And go ahead, Lynn.
Yeah, I was just gonna say we might have to follow up on that one because Rachel probably would have been the best to answer that. I think yes, but let's answer that one in writing.
Okay, perfect. Okay. Question here. The trust plans for investing funds. Do you plan on it being invested back into carbon projects or more classically into the stock market, real assets, or both?
Yeah, I think most likely we're seeing it'll probably be a mix of both. So likely some money in the trust will need to be invested to grow so that it is fully resourced by the time we need it, decades into the future. Um, and like we've talked a little bit about, we anticipate at least a portion of the fund being used to actively prevent reversals on the ground. This gets a little bit at another question I think I saw somewhere about what's the scale of the trust. Um, as of now, and maybe something we didn't fully say up front is we don't intend to be the ultimate home of the trust. We're doing a feasibility study because we believe in this as a concept and a needed piece of market infrastructure. And we ultimately think there will be a different home and probably multiple homes. So we're because we're seeing this need for that on the ground reversal prevention, which we think will be most successful if it's place based and geographically based. We suspect probably the most likely path is regionally based permanence trusts, so multiple that are large enough to have that diversified portfolio that Bali talked about. But not so large like global that they can't also be really effective at kind of that place-based reversal prevention. So that's what we're seeing now. We should have more on that as well about what are the different options for scale in the forthcoming reports.
Perfect. Thanks, Lynn. This question likely best for Bali. Could you walk through how reversal risks in any given ARR project is being estimated? And what do you think is making the huge difference between the US and Australia ARR?
So our current model is a proof of concept model. We're looking at fire data using GWIS. So we pull down regional fire burn rates from around the world and also contrast that with regeneration. Um, Currently, how the model is done is looking at hectares at risk. So a part of it that would be kind of important to your question as well, that we need to integrate is what is the carbon stock? What is actually being grown on these lands, and how much can you expect? How much carbon can you expect within these areas? I would say that as the model only covers those two aspects, I would say that the fundamental driver of risk between sort of Australia and the US in this current model is the rate of fire versus the rate of regeneration. But the idea is to include other drivers of risk, like potentially pest, deforestation, etc., into the model as we continue to develop it.
I'm going to pose this question to both of you as well. I think it's a very good question. Because of those differences that we see in the model between Australia and the US and the driving factors, do you foresee that using tools like this may disincentivize ARR in Australia?
Potentially, and I think that's where the idea of what a global portfolio looks like becomes really important, right? So maybe ARR is not best carried out in Australia, but perhaps they have lots of mines there. Maybe it's a great place for enhanced rock weathering. Perhaps biochar is a good, it's kind of this idea of at a global scale when we're thinking about Article 6 mechanisms, in fact, and corresponding adjustments and actually trading carbon credits internationally, what can each country best provide in terms of carbon removal storage? So that isn't to say that you can't do carbon removal in Australia, and you could still do forestry as well. The risk premium would be higher, and so that might mean that the kind of decision making shifts to another kind of method in those areas. Um,
Yeah,
Yeah,
that was going
I
to
would.
answer. Oh, sorry, go ahead, Lynn.
Oh, sorry, Christina. I was just gonna agree with Bali and add, I think the goal is not to make any judgments about where projects should or should not be doing, but just to be really clear-eyed and realistic about the cost of achieving a specified durability threshold if we do choose to do those projects in those places. So that's the goal, is just to accurately price that in, but not necessarily say where projects should or shouldn't be happening.
Perfect. You said that better than I was going to. Um, so this is a question I think again that both of you could contribute to, but when we indicate that current and future loss rates are manageable, um, and sorry, I'm reading two different questions at the same time. I'm going to go to this question first. So the analysis that we're applying for current and future loss rates to estimate, would we be able to apply similar analysis to estimate whether buffer pools are also able to ensure long-term durability?
Yes, I would say it's pretty much the same analysis. From my understanding, currently buffer pools normally do like a flat rate deduction of around 20%. And I guess what you're starting to see with this car model is that you would want to perhaps calibrate those deductions to specific risk drivers and factors in the regions where those projects are being implemented. And yeah, the kind of advice from Carr would be to move away from just the mean expected outcomes and also incorporate some of that tail risk when thinking about buffer pool contributions.
Yeah, and I would just add, I think, to the first part of the question, Christina, about what do we mean when we say the risk is manageable? Um, I think what we mean so far is a little bit more thinking about the financial modeling aspect, which is taking these risk rates from the carbon at risk tool and then putting them into a financial model that also necessarily includes assumptions on what is going to be the price of that long-term land stewardship, long-term monitoring, and compensation for reversals. And what we're seeing in that financial modeling piece is that these things do seem to be manageable, meaning they produce a viable financial model. That's obviously sensitive to different assumptions we might make on how much all those things cost, in addition to the inputs from the carbon at risk tool. So I think the finding there is just that so far it seems viable. And we should have more specifics on that in the report later this year.
Perfect. Thank you. I answered both questions, even though I combined them into one question, so I appreciate that. Okay, so a couple of questions here. First, is the intent of the Permanence Trust to run in parallel with project developers' mandatory contributions to a buffer pool?
Yeah, I think so. Although this is something that we would really like to have more conversations with the standards about. So one potential path I could see is that the time frame that a buffer pool covers could differ depending on when that transfer of liability to the trust is best placed. So maybe that means that a buffer is used for, let's just say, like a 40-year period in line with the current core carbon principles from the ICVCM. That could be true, and then after that 40-year period, the liability transfers to the trust. That's more just a speculation. I don't know if that's how it'll actually work, but that's just to say we think these two things can work together. So there might be a buffer contribution that is scaled to the time period that the buffer covers, and then a fee that goes into the trust that makes sure that any time after that is also covered through the intended durability thresholds.
Perfect. Okay, I'm gonna scroll through here. Okay, this is a good question. How are you determining what the risk profile of an ARR project will be in 100 years or 200 years, given the uncertainties and how climate change scenarios will evolve?
So I can talk a little bit about this, but when we're looking at particularly at the portfolio level analysis, we are including different climate scenarios and modeling outcomes as different shocks to what that would look like. And so we are including that analysis, particularly when thinking about how a portfolio of carbon removal solutions, which would include ARR, may change over 100 or 200 year horizons based on these different warming projections.
Perfect. And I'm scrolling down here and appreciate uh, Ben adding in some additional information as a question to an answer. So yeah, if folks, the disparity between Australia and the US, if you're looking for more information, Ben has added some into the Q&A section. So, and also some information on methane as well. Okay, what is the earliest you think project developers might be able to participate in this? When is our goal for go live?
Great question. Yeah. And we hear this from project developers and from buyers who want to be having this mechanism on the credits that they purchase. So I'll say we intend to have a report out on the feasibility study in the coming months. In the meantime, like I said, we don't plan for this group working on the feasibility study to be the ultimate home of a permanence trust. We're really committed to testing the feasibility, but we also right now are going to be looking for where could the Permanence Trust live. Is it building a new endowment institution? Are there existing institutions who this could fit in their scopes of work? So we're having some conversations with potential homes for the trust. If folks are out there on this call and want to reach out to us with ideas or are part of an institution that think this could fit into, I think we would really love to engage more on that, with the ultimate goal being to pilot as soon as possible. So yeah, I would speculate that piloting and something people could participate in would be on the order of months to sometime in 2027-ish. But yeah, hopefully that'll become more clear as we have these conversations and answer that kind of what is the home of the trust or multiple trusts over the coming months.
Perfect. Yeah, I'm gonna have this other very fundamental and very common question that we are getting. And have we done any research on what the price per credit would be to adequately fund the Permanence Trust? And that is the research. That is the modeling that is ongoing currently. And so that is the question I think that we're ultimately trying to answer. And so at this halfway point, while things are looking feasible, we are still building out those models. We are still trying to make those determinations on how we adequately price per credit, depending on project type, depending on region, depending on all kinds of different factors. And so that is the ongoing research right now. Yeah, Bali, Lynn, I don't know if you have anything else to add to that, but these might be just some of our final thoughts here. Okay, well, thank you all so much. I know we weren't able to get to every single question, but as I said, we are collecting those questions. We will bring them back to the analysis team and we will be following up. I do encourage you to please reach out to the Perm Trust email. We will be sending out this slide deck, but to join our email list because we do send out regular communications. And yeah, stay tuned because there's going to be more coming out from this research project. So thank you all so much for joining us today. We really, really appreciate your time. And thank you, Lynn, and thank Bali for presenting with us today.
Thanks, Christina.
Thank
Yeah.
you.
All right. Well, goodbye, everybody. Have a good day. Thank you.